Okay.
Can you tell me your name, though?
Oh, Jonah Schumer.
Thank you.
Schumer. That's all up. Okay. Okay, so I'm going to talk about hedge funds today. Before I say anything else, I just want to jump right into it. This is John Paulson's $53 million Colorado skiing ranch. His net worth, $12.5 billion. This is Dan Loeb's 200-foot, $53 million super yacht. His net worth, $1.5 billion. And this is just one piece of art in Stephen Cohen's massive collection, worth $64 million, and his net worth is $8.8 billion. Now you're probably wondering at this point who these people are. What do these billionaires have in common? Well, Stephen Cohen, Dan Loeb, and John Paulson are hedge fund managers. Now most have heard the term hedge fund before, but know little to nothing about what it really is. So what is a hedge fund? Well, John Burbank, who's a hedge fund manager, he defines it as an incentives-aligned, risk-seeking vehicle that can encompass virtually any investment strategy under any market condition. Now that's absolute gibberish, so let's simplify things. For one, a hedge fund is a pool of money. Now this pool of money is managed by an individual and his team, and depending on the hedge fund's investment strategy, they may invest in more traditional things like stocks and bonds, as you guys know of, and then you might know of these also more sophisticated, kind of sexy assets like derivatives, commodities, futures, options, more complicated securities. And money in a hedge fund comes from several different places. So you have the manager, me, and I will invest a significant portion of my own wealth in the fund because that will show the investors that my interests are aligned with that of the investors, right? I'm sticking my neck out. I have money in my own fund, meaning that if I perform poorly, then I'm losing money also. So I have a great incentive to perform well. And then you have accredited investors, which are just wealthy individuals, people with $2 million more as a net worth. And then you have institutional investors, and that's usually university endowments, manageable ones, not all unmanageable. And then you have pension funds. Hedge funds make money for the manager and the team with fees. You have a 1% to 3% of assets under management, which is kind of right off the top. So no matter how much money I'm managing, I'll take a little cut of that if I'm the manager. And then the big fee is the performance incentive. So I want to perform well, so I can take 20 to 50% of the annual profits. The typical fees you hear are 2 and 20 in the industry. Now, over the past couple decades, hedge fund managers have kind of become the new Rockefellers, the new Vanderbilts, the new Carnegies in this age. They are increasingly called up by the federal government to talk about financial regulation, economic growth, fiscal policy, that kind of thing. And they really have become sort of the new elite. And the funny thing is that they're so powerful and really no one knows who they are. Because of regulation in the industry, they're kept kind of under lock and key. It's very mysterious, and the whole industry is pretty enigmatic. And so I wanted to find out what makes a successful hedge fund manager. I would love to be a billionaire, so I wanted to find out what approaches, lessons, principles that they share. And I knew that there was no one recipe. These guys come from, they have totally disparate backgrounds. So you have guys with 20 years in the financial industry, working at the biggest investment banks like Goldman Sachs. And then you have guys who majored in the classics, studied engineering or have PhDs in poetry. One guy had a PhD in poetry, so that's weird. But I wanted to find out what they had in common. So I used some connections I had, and I interviewed 5 people. Guys like Whitney Tilson, he's a hedge fund manager of Case Capital, and Adam Joff, the manager of the Boston company Asset Management. And I wanted to find out, what made them effective at what they did. Who their investing idols were, what mantras did they have, what are some things that they stress with their investment team, so that in the future I could do the same thing. And of course I read a ton of books, and that's not all of them. Although I'm not going to say that that was boring, because these are actually great reads, even if you don't know much about the industry. And so I came up with 5 kind of must-haves for a hedge fund manager. And I want to go through these. So we have patience, adaptability or flexibility, guts, connections, and a good business sense. Start with number 1. This is a chart of the Dow Jones Industrial Average from 1900 to the present. And if you guys don't know, it's basically a market snapshot. It's a weighted index of kind of 30 large companies and the publicly traded companies that from all different market sectors. So you have communications, retail, heavy industry. So it gives you an idea of how the overall market is performing. And this illustrates a basic principle that over time, the market tends to go up. If I'm thinking over the long term, I have a much greater chance of doing well in the stock market. You have periods of recession or depression, but overall the market goes up. So the best managers and the best investors in history have utilized this basic principle, and they think long term with their investments. You guys probably know who Warren Buffett is, aka the Oracle of Omaha. And he once said, if you aren't willing to own a stock for 10 years, don't even think about owning a stock for 10 minutes. He would love to say that his favorite holding period for a stock was forever. He would love to see a company continue to grow and grow and grow, and he would own stocks for 10, 20 years. Now that's an extreme case. Most don't hold it for that long. But you do have guys like Michael Steinhardt. He's a hedge fund manager. I think his fund, Steinhardt Partners, it manages around $15 billion. And he's considered a trader. He considers himself a hedge fund trader, meaning that he might buy a stock and he might sell it in the same week or the same month. Now, this is the sort of traditional long-term horizon that I'm talking about. But it still illustrates a sort of self-control. He still has to demonstrate a self-control in the markets, knowing when to buy something or when to sell something. Being able to, part of patience is being able to ignore kind of short-term, price fluctuations. If I have an investment in the market and my reasons for having that investment are still entirely valid, I'm sure this is a great investment. Even if the price goes down a little bit, I'm not going to freak out. I'm not going to sell immediately and lose my money. I want to be sure about my investments and be, astute with the way they're going to go. Adaptability or flexibility. A manager may have been trained in a specific way. They might have been brought up in a certain Wall Street culture at the time. They have a certain area of expertise, and they love to exploit the kind of bread and butter strategies that they know. The truth is, though, in order for a manager to survive over the long term, they need to be able to be flexible. They need to explore other market opportunities. So, for example, James B. Rogers, he was a hedge fund manager back in the day. He's retired now. He said, be aware of change, buy change. You should be willing to buy and sell anything. Some people say, I can never buy that kind of stock. I can never buy utilities. I can never buy commodities. You should be flexible and alert to investing in anything. Now, this is my example. George Soros, he's the most wealthy hedge fund manager in the business. He's worth $20 billion, which is so much money. He started out on Wall Street as a stock picker. That was kind of his thing. He was a fundamental stock picker. He lived in the charts. And his first kind of early funds relied on his ability to do just that. He's been around for a long time. But as his funds grew bigger and bigger, and he had bigger name clients that wanted more money from him, he knew he had to expand his horizons. And so he became a currency trader. You can buy and sell things like Japanese yen or US dollars or British pounds, and I can explain that at the end. He once said, it's much more useful to know a little about a lot of things, so it's easier to spot where the big wave is coming. And that's what he did. He spread out his knowledge base. He took a step back, he learned more, and in the end, he became a currency trader, and he once generated $1 billion in one day. He did what's called shorting the British pound, in which he wanted the value of the British pound to decrease versus every other currency that's tradable. Guts. A manager really, in order to be successful for his clients, has to be more focused on making money than scared of losing it. He has to be willing to take risks, step in the way of market danger. Maybe the market has a consensus about a company. That company's going to fail for sure. There's no way that's an unsustainable business. A manager has to look at that company and not just agree with what everyone else is saying, but analyze it for himself. Maybe he thinks that's a great investment opportunity, and he should go for it. So you have to be willing to disagree, to take big risks. For example, David Tepper, he's manager of Appaloosa Management. his competitive edge, he thinks, really lies in the fact that he's willing to take these educated risks. He once said, "We're not afraid of the downside of different situations once we've done the analysis." Some other people are very afraid of losing money, which in turn keeps them from making money. Following the financial crisis in 2009, when everybody was, licking their wounds and timid about investing again, he kind of stepped in. Even his fund was down 27% in '08, which is, astronomical, right? Imagine if you invested $1 million and you just lost, a quarter of it. The next year, when everyone was still timid about investing, he jumped in and he bought up all this stuff that was so cheap because no one wanted it. All this kind of debt, credit card debt, you can purchase that kind of stuff in the market. Mortgage-backed securities, which is kind of what caused the crisis in the first place. And he bought all this so cheaply, and then that following year, he had a record $8 billion gain for his fund. I think that was 122% gain. So if you're someone who invested $1 million, you now have $2 million. More than that. And I should tell you that he personally took home $4 billion, which is quite a paycheck for a year. Connections. The global financial industry is really one big network of people, always talking to each other. And the best managers and best investors, they use this network. They utilize it to find new investment ideas. They use it to make more money, to avoid losses, to find out which investments they should stay away from. I interviewed Gerard Getz, he's an analyst at SAC Capital, which is a hedge fund. And he said the best managers gather information from other funds and other managers and figure out how to focus their time and money. There are over 60,000 publicly traded companies around the world, so it can be hard to know, where am I going to invest? What am I looking for? So, he'll often call up a friend of his at another hedge fund, and he'll ask questions like, "What do you think about company XYZ?" Or, "What have you guys been looking at recently?" He's trying to get ideas from other people. There's nothing wrong with that. It's nothing shameful about, it's not stealing ideas. It's trying to find out, where to direct your attention. Use your time effectively. Julian Robertson is one of the most famous hedge fund managers of all time. He was manager of the Tiger Fund years and years ago. He's retired now. And he was really known for his social investing style. Like that was really his competitive edge in the market, is that he had a brilliant network of people. And he was always looking to make new friends in high places. And not even necessarily in high places, just people with expertise that he didn't have. Engineers, people outside of the world of finance. An analyst at his fund would pitch him an idea. "I think we should invest in this company." And he'd soon be on the phone, with a guy from that company, trying to get the inside scoop. Now, hopefully most of that is legal. Occasionally you got guys, getting some information that they're not privy to. And then finally, the best hedge fund managers are business people. And the meaning of this is twofold. So for one, they're focused on client relationships. They're focused on their reputations, building a name for themselves. I interviewed Dr. Paul White of PNC Wealth Management, Mr. Kenosi's buddy, and he said great managers are focused on client money and growing a business, making a name for themselves. You can be the smartest guy in the world, but if you don't have a name for yourself, a good name for yourself, you won't have a business for very long. A strong reputation is very important. He said to me that, if there's one thing you should never do, it's do anything illegal. Now, not everyone follows those rules, but it's incredibly important to have a name for yourself, because you want investors that are going to stay with you for a long time. You don't want what's called hot money. You don't want people jumping in and out of your fund. You want long-lasting relationships. And even the best funds, the most long-running hedge funds, have losing years sometimes. Sometimes there's a financial disaster, or they just perform poorly and they'll lose their client money. And he went on to say that years when you don't perform well, your business has to carry you through to raise, or at the very minimum, preserve capital. And what he means by your business is your reputation, your name. And the second part of this business sense is on the investing side. It's thinking about companies as companies. When you invest in a stock, in a company, you don't want to think of it as just a balance sheet or a chart or a stock on some exchange. You want to be thinking of this as companies, investing in companies that you believe in. So you want to understand how businesses function, how they grow and compete. You got these guys who just look at charts over the long term, and that really doesn't work. It's not a sustainable thing. might get lucky. Warren Buffett once said, "I'm a better investor because I'm a businessman." And then I interviewed Whitney Tilson I mentioned earlier, and he kind of reinforced this idea. He said, think about the investing as the purchasing of companies rather than the purchasing of stocks. So just to reiterate, patience. Best managers think long-term with their investments. They can ignore short-term changes, and if their reasons for being an investment are still there, they'll stay there. Adaptability or flexibility. They're willing to explore other market opportunities that they're not necessarily familiar with. Guts. They have a willingness to take risk. They're more interested in how to make money than how not to lose it. And connections. They use their network. They surround themselves with people of intellectual stature, of at their height or higher, people with expertise that they lack. And then business sense. They're focused on their reputations. They want long-lasting relationships with their clients, their investors, and they think about investing as the purchasing of companies rather than just something on a stock exchange. And so what do I do with all this information that I learned? I started my own little hedge fund. It's a mock hedge fund. It's not registered, and it's not enough money to even be registered in any way. And I called it Schumer Asset Management. I know it's got a nice ring to it. And with these characteristics in mind that I just described, these 5 characteristics, I invested in companies, and I wanted to really embody these qualities that I discovered. So I was going to think long-term with my investments. I wasn't trying to time the market, predict when it's going to go up and down. I was investing in specific companies that I thought would be great over the long term. I believe in this product no matter what the numbers are. This is kind of with the flexibility, adaptability. I wasn't going to limit myself to anything, to one market that I knew really well. I have a passion for cars. I'm kind of a car guy. And I wasn't going to invest in, 6 automotive companies just because I know the automotive industry really well. This kind of goes with guts, and that I wouldn't be afraid to increase a position of mine if the opportunity presented itself. This means that, say if I bought a stock at $15 a share, and that stock went down to $13 a share. Now I've just lost money. But if my reasons for staying in that investment are still valid, I still believe in the company, it still has great opportunity, great potential, then I'll buy more, right? Because now it's at a cheaper price than it was earlier. I just bought it at $13 a share, so my upside, what I can make is even greater. And then connections, I talk to people, I asked opinions of those with, expertise that I lack. My grandfather was a CEO of an energy company back in the day, so I asked him about, the best energy companies in the business that he thought. My uncle is a CEO of a tech company right now, technology company. So I asked him what he thought of certain companies in that sector. And finally, I didn't want to be shady to my investors. I wanted to frequently update them on my fund's holdings and future plans, the performance. I wanted them to trust in where their money was and not just with, a shady guy. And of course, it's not large amounts of money, so if I lost it, no one would be too upset with me. But I wasn't going to lose it. I was going to, make sure that they knew exactly what was going on. So I'll just tell you my companies I invested in. I invested in Ford Motors Corporation, which you guys know. Senior Energy, which is a liquefied natural gas exporter. And I had that letter out, but you guys are willing, you can ask me after why I invest in these companies. Genworth Financial, which is an insurance company, mortgage insurance and long-term care life insurance. And American Eagle Outfitters, which is a clothing retailer. And I went what's called short on Gamestop, which means that I wanted Gamestop's value to decrease. I invested in such a way that I want the value, I want the stock price to go down, and I'll make money from that. Now I want to take a step back for 1 second, because so far I've discussed, how hedge fund managers have, super wealthy guys, and it sounds like they're just a bunch of greedy guys, and they're the only people that benefit. Wealthy guys, hedge funds make rich people already richer. And while some of the money in hedge funds is from wealthy individuals and the managers, the vast majority is institutional investors, like I mentioned. So university endowments. Now, what are endowments responsible for? Financial aid, getting kids to school scholarships, and of course, new programs to the university. And then, pension funds. This is CalPERS, the California Public Employees Retirement System. And obviously, the benefits of that are self-evident, right? People have more money to live on later in life. Hedge funds are also, they may soften the impacts of financial crises and market conditions and identify weaknesses in certain financial and central bank policies. So what I mean by that is hedge funds are kind of the biggest short players in the market, meaning that they're often betting the market may go down. And so if you have everyone in the market is expecting everything to rise, right? Everyone's long, what's called long on stocks, right? If all of a sudden, everything collapses, everyone loses money, right? There's no winners in the market. But if you guys take the opposite approach, it really softens the impact of a market correction, which means the market goes down. Also, hedge funds are usually, because they have so much influence and so much assets, such a big capital size, they're often the ones who may find weaknesses in, certain policies. Now, they may profit from these weaknesses, for sure, but, them profiting is a lot better than, the public, suffering from these kind of problems. So our hedge funds, they get a bad rep, hedge funds, for sure, because you have these rich guys managing the funds, and people like to point fingers at rich people, which is absolutely, justified. But really, by nature, they're not inherently evil. And the reason is they're too small. They're small enough to fail, excuse me. Now, this means that when hedge funds screw up, no one else pays the price except, the investors in the hedge fund. But when a big bank collapses, like, if Bank of America were to collapse, or like Bear Stearns, the Lehman Brothers collapsed, everyone feels the impact of that. Every taxpayer feels the impact of that. Hedge funds have no backing from the government. They're responsible for their own money. They have to do their own risk analysis. And so they're really not the bad people, the bad people inherently in the market. People should, understand that the government involvement is actually a really important thing with, investment banks, and that, it may be a good thing to keep the economy afloat, but it means that you're as a taxpayer, you're on the line, right? With hedge funds, you're not. They have nothing to do with you. They just make their own money for institutional investors and other investors, but they're not, relying on you to bail them out in case they screw up. And that is it. So thank you very much.
We have time for Q&A.
Okay. Yes.
First off, good job.
Thank
Very
you.
informative.
Thank you.
So I'm just curious as to what specifically hedge funds managers look for when they are contemplating investing in a company. Like I know, they had, like you picked the 4 companies that you had displayed up there.
Right.
Like what specifically, besides, I know the analyzing your risk and
Right.
reward and whatnot, but specifically, what do people look for?
Well, the best managers, they really want, they want to see a product that really is sustainable. You have companies that come and go, like people think Apple is done for, because it's this technology company that has this phenomenal idea, but then, technology is always changing so much. So why would I invest in a company that may be obsolete? Their product may be obsolete. So they really want to believe in the product that's being sold. And obviously, it comes down to earnings, What are they going to be generating earnings every year? What are the correlations involved, In certain companies, let's say some kind of food company, they may be impacted by a famine halfway across the world. So you need to understand what the risks are involved. There's so many factors at play, like weather, may be something that's going to impact investment years. So you have to look at all, market players, every situation. But really, it comes down to just believing in the product that the company is selling,
Can you talk a little bit more? You were going to share why does you invest in the companies that you invest in?
Oh yeah. So did you want like a specific which one?
Yeah, just send to on a couple of them.
Oh sure. Yeah. So Ford is what's called a cyclical stock, which means that it's going to do well in periods of macroeconomic growth. Just overall economic growth, which is one right now, and it's going to do poorly in times of recession. And so right now, with the housing recovery and everything, which is kind of a main catalyst driving people to buy more cars, that's really what it is. The demand is increasing so much for vehicles right now, as opposed to what it was a couple of years ago. And I chose Ford over General Motors or Chrysler because I love the Ford management. They were kind of the ones that avoided their big government bailouts. The CEO, Alan Mulally, is a He's a genius. He was able to secure financing so they wouldn't have to go under and be bailed out by taxpayers. And obviously, I believe in their product. I think Ford cars they're benefiting from, more global recognition of their quality and their brand.
And what about the fuel?
And then, right, so Cheniere Energy is a liquefied natural gas company, and right now we're in kind of a natural gas boom in this country. There's huge supplies, which means the price is incredibly low in the United States, but everywhere else in the world it's high. So there's this big price spread between what natural gas costs here and what it costs overseas. So Cheniere is exporting natural gas, so they take advantage of this big price spread, and they also liquefy it, and that means you can transport it in much larger quantities in a smaller space. And let's see what's next. Genworth Financial, that's an insurance company. So I'm doing that one primarily for the mortgage insurance, right? So the past couple of years, the housing market's been dead, right? Because the whole crisis was based on, homes. So Genworth is doing so poorly in the last couple of years because mortgage insurance is required if you don't put down a certain amount of money in your home. Like, you have to put down a certain amount to not have to get mortgage insurance, but many do. Many are obligated to. And so that company just they just announced like a surprise profit on that sector, the mortgage insurance sector, which means that people are buying more homes. The housing recovery is kind of in full swing, and that's sort of their core operation. So they're going to do well as the housing recovery continues to do well. And then American Eagle Outfitters, I kind of took like a more Warren Buffett approach on this one, and I invested in a company that I really know, and I have experience with. Like, I shop there, you know what I mean? I think it's a great product. I noticed that it's competitively priced, but they're not always discounting. There are certain stores that, as consumers, we're like, oh, awesome, sales. Like, that must mean that this is a great store and I love it. But for the company, it means that they have too much inventory. You don't want, if a company is always discounting its stuff, it means that they're losing money or they're not making enough money. And I noticed that American Eagle, while it's competitively priced, it doesn't necessarily discount its clothing all the time. They've done a good job controlling their inventory, not producing too much clothing, and they're selling well. And also, now that we're in a period of economic growth, people are buying more clothing. When people feel richer, they buy clothing, and then when they don't feel richer, they just sew stuff. And then GameStop, the video game industry right now is kind of in a period of transition where it's away from retail and into kind of digital downloading. So now you can download things straight from the internet to whatever your console is. And GameStop is a retailer, right? It's a video game retailer. So their business model is it's going to become obsolete in the next few years as digitization takes over. I think that was the 5, right?
So can you explain briefly how you make money by investing in something that's going to go under?
Oh, right, so shorting stock, right. It's kind of counterintuitive to think about. What you do is the process is you borrow a stock you don't own, usually from a broker. You borrow it, you sell it at a higher price, and you buy it back at a lower price. So it's really counterintuitive to think about, but you're technically you're still selling high, you're still buying low and selling high. You're just doing it in the reverse order. So that's a way to bet against companies that you think are overvalued or obsolete. Does that make any sense?
Yeah, so then you just keep doing that over and over as it drops again, then you...
Right, so...
what happened? You're stuck with bad stock in the end, ultimately. Right?
Well, you buy it back, but it's actually called buying to cover, which means that you buy it back, but your broker or whoever lends you the stock kind of takes control of it, and so you pocket the difference. It's really doesn't really make too much logical sense, but it's just
Is that the part that gives hedge funds the bad reputation? I mean, the part where they're kind of betting people are going to go belly up.
Well, it's actually, some would argue that yes, shorting is inherently kind of evil, but really it's just keeping the market in check. You have companies that are overvalued, that they shouldn't be so highly priced.
Right.
And sometimes companies are really fraudulent or they have issues, and when you short the stock, the company goes down and everyone's happy. There's a kind of a short-term loaning company, and they provide like payday loans, that kind of thing. And those companies are horrible, first of all. The interest rates are just insane. And there's all these fraudulent practices, so everyone shorts the stock, and the stock goes down to what it should be, not $100 a share, but half that. So shorting it depends how you think about it, really. But hedge funds sometimes can be responsible for you know, they have so much influence. So if the biggest hedge fund manager in the business says, I hate this company in public, then everyone else, you know, then the stock takes a hit. And that's that's questionable, right? All right.
All right, thank you. Good job.
Thank you.
I'm sorry. Two things. What are you doing next year, and are you going to continue with this in whatever your plans are for next year?
Yeah, I'm going to go to a business school of some kind. I don't know yet because I'm on the wait list for a couple. Hopefully NYU. And I do want to continue studying finance. And hopefully y'all see me on Forbes someday.
Forget about it, Star.
Yeah, I know.
What'd you say?
Don't forget about it.
I'll be back here.
Congratulations, man.
Thank you very much.